I guess one thing we did want to touch on, or I'd love to get your perspective on, is just like the state of what you're seeing in the market. You see more Series A, Series B than I do. We haven't done kind of a macro update. I talked to Josh a little bit about it last week, but what's kind of your purview of what's going on right now?
Yeah, I would say, and it's not, there's probably more than this, but we're seeing, let's say, three themes, if you will. Uh, the first is that the flat Series A, Series B is real. We're seeing companies want to pad their balance sheet for a variety of reasons, and valuations have definitely reset for companies that have numbers. They have customers, they have numbers. So market is resetting, I think, at the B, and we're even seeing it a little bit at the A, just in terms of valuation expectations for those
Is it
rounds.
mostly from inside people kind of doing extensions, little stubs, or are they net new investors coming in for the most part?
A little bit of everything. I mean, definitely heavier on the insider round
Yeah.
for sure, or the strategic you wanted to bring in that you didn't in the last round, and now you open it up. I don't think we're seeing like a full rationalization of pricing yet, because we haven't seen the vast majority of the companies go out and fundraise, because the ones that have cash are not doing it. So you're
Yeah.
seeing like a little bit of trickle. There's very clearly valuation expectations are down. Really, I think for one somewhat simple reason, which is, when you're underwriting high price Series A and Series B investments to outcomes that look like 5, $10 billion market cap businesses, and those don't exist in that market anymore, the macro, like, public market expectations are down. Okay, well, then your underwriting has to change, and that's what's happening, right? I think
Yeah.
it's just simply a multiple reset.
Our early stage team, by the way, I was surprised to hear that it had flowed through as quickly as it had. Our early stage team said that they've seen prices down, 20%, in some cases 50% of what, an 80 is now a $40 million valuation or something, which I was surprised. I guess not totally surprised because like the end state of these outcomes have shifted. But the funds were raised at for a dollar amount to invest a certain, number of Series A's. Like if you think about portfolio construction, I don't know how all firms do it, but a lot of them will say, hey, we'll do 35 deals in this fund and we'll average whatever, 10, $15 million a deal, and we'll blend up to 20 in some cases. And so we have a $500 million fund or something like that. Right. And I guess people are just kind of shifting to, hey, and it's kind of a prisoner's dilemma where if anyone stays in the old mindset, then that's probably stays the market, broadly speaking, right? But I guess people are just kind of saying, hey, I'll either buy more or write less and have more companies in the portfolio. And so I'm kind of surprised it's flown through to the Series A, I guess, as quickly as it has here in the last, whatever, 6 months.
I think you're gonna see fund life cycles go back to what they were.
Yeah.
It used to be like a venture fund was, 3 years or so, if not more, to deploy, 2 to 3 years, something like that. And then you were seeing things get deployed in like 12 to 18 months, and we'll probably go back to longer deployment cycles because, the round sizes will be a little smaller and a little slower. Personally, the one area I haven't seen it play out yet is in the true, like, pre-seed seed valuations. Like when I was raising money for Invite Media, this is in 2007. I'm pretty sure I gotta talk to Nat about this, but like I'm pretty sure our post money on our seed round was like 2.5 million,
Yeah.
maybe 3 million, something like that.
For
And
and
then
how
you
much
saw
money how much of the company did you give up or how much money did you raise?
somewhere between 500,000 and 750 or so. Or the round sizes were smaller too. It was less competitive at the time. And then, you started to see rounds like in the 6 post and 7 post in the early 2010s. And then eventually you were seeing these seed round. And I define seed really as like, you don't really have paying customers in any way, shape or form. And
Yeah.
that's like, there's a variety of ways to measure it, but that's probably the best one, I think, or at least for me. And then you were seeing these like 15, 20, 22 on, good ideas with good founders, but you've basically got nothing. And I think all of that is predicated on this idea that like, well, you make a bunch of progress and then you do 20 on 80 and there's the markup. And if those 20 on 80s are now 20 on 40 or 10 on 40 or 10 on 30, which is more likely these days, you can't do a seed round with that kind of failure rate at 16 post. Like it just, the math doesn't work as a seed investor. The challenge, I think, is that a lot of seed investing is done by people who haven't been through an entire cycle, and that math is not intuitive to them. And so, your 6x seed fund becomes 2x very fast when your entry point price is like 20 posts. So I have not seen it. I'm curious if your early stage team sees it, but I have not seen the seeds down.
Well, you know what the thing is, right? If you think about a lot of these seed, pre-seed funds have now, like the good ones have kind of crept up the, 50 million plus, right? At least 40, 50 million. Some are at 100, 150, 200. And so if you think about it, like the point I was making earlier about just like the fund construction, I would have to imagine, like, let's take your example. You gave up 750, and maybe it was like a $3 million value, whatever it was,
Sure.
right? And now, or 25% of the company, and now these funds are structured where they need to write $2 million checks, right? And so that same round is now 6.7 or whatever it is to get 30% or 7 million, whatever it is, right? Does it really matter? The situation that I guess you could talk yourself into the mindset that, hey, if this works, right? This is going to be a low enough absolute valuation, even if it's a $7 million valuation, right? And now the round's getting done at or 12 or 15, right? And the next round's going to be, if they make progress, is going to be at 30 or 40 pre or something like that, right? Does it really matter when the ultimate outcome has gone from being 12 billion or 10 billion in these success cases to 5 billion? Like, where does it really matter that the valuation has creeped up a little bit more, right? And I would say, I guess it really matters if the Series A is in trouble to get done because there's too much compression there. But I guess you still have buffer, right? Now, when you're doing $20 million valuations, $30 million valuations on these seed deals, you don't have buffer anymore, right? Like you're looking at a flat Series A.
Look, it only matters at the outcome. Like the A is like, oh, whatever. The A, the B, these are just like financing events. You're not selling. So all that really matters is how much money are you getting back when this thing has this liquidity in, 10 to 15 years. So the rest, the A, and it's just a proxy for like what this might be at the end. And the best example I can give you, at least in my head, is if you did the round at 5 million post, or you did the round at 15 million post, that's 1/3 the outcome. Like that's the difference between a 6x and a 2x right there in terms of a fund, if it's just one company.
But if you're a seed manager, right? Like how often is the 6x or the 2x a fund driver? I would say that like most of the seed managers.
Oh, I mean, sorry. When I say 6x or 2x, I mean for like the overall fund, not on an individual deal. What drives it is your 150x is now a 50x. That's the difference. And then because you only get like one or two of those in a fund basis, that's what drives the 6x down to 2. That's really what I mean.
I guess I would say that like the difference between if you hit a 50x or a 75x in a seed fund, right? Like it's probably going to be a good fund, depending on size and whatever, but it's probably going to be a good seed fund in general, right? I would think, and we'll see. But like certainly if you're hitting a 250x or a 500x, like it's clearly going to be a good fund. I guess the argument I would make is that the ball goes a lot further on the upside regardless. And so oftentimes one of the things that I don't think has been true of late, but like one of the mantras when I originally got into venture was like, within a certain low enough absolute valuation, you're usually not wrong on price, right? And the rationale was like, your return threshold almost never blended to be like within a margin of what the fund success is. As a basket across the fund, it can, and certainly as an asset class for LPs, it totally does, right? Like, but any individual investment, I think that's why the seed people can probably talk themselves into not moving that much on price. Is like, hey, if you like it at 5, you should like it at 10, right?
Well, let's do like the math. Here's where I think it plays. So let's say like you have $100 million seed fund, right? And one of the downsides of running a seed fund as a investor is that you don't make any money on the fees. None. right? You know, your $100 million seed fund is like a 2% management fee. So you've got $2 million in management fees. There's probably on a $100 million fund, 3 GPs, let's say, maybe 2, but let's call it 3. So you've got $2 million to spread across 3 people, plus some associates, plus overhead. So I don't know what the GPs are paying themselves, but it's not, no one's buying their Hamptons house on this fund. I'm not crying for them, but they're not making a ton of money on the fee. And then all of a sudden, what you get to at a certain point is like, if that $100 million fund is a 3x fund, right? So let's say it returns 300, your carry pool of the $200 million profit is 40 million bucks spread across, you know, it's over 10 to 12 years. You did okay. And you gave up the opportunity cost of working at a really big place with a high management fee where you were making like $2 to $3 million a year. And that's that opportunity cost of being a seed investor versus going and working at like a growth fund. If that fund is not 3x, but if that fund is 7x, right? That's a $600 million profit pool of which you're splitting $120 million across 3 people. It actually ends up being a very, very big difference for individual GPs, the difference between a 2 to 3x fund versus like a 7 and 8.
Oh,
And I think
totally.
that's where it
Totally.
matters.
But
That's
I guess my argument would be any individual investment, it's hard to internalize like at the difference of 5 versus 10. You certainly want to play the game that's on the field and pay the fair price, right? But I don't know. It would be really hard for me. I'm not a seed manager, and maybe this is why I'm not, is because I can't internalize this stuff. But it'd be really hard for me to talk myself out, knowing how fund construction kind of works. It'd be really hard to talk myself out of a deal at 4 versus 6 versus 7 or whatever. And I realize it matters, but
yeah, you're probably right in that range, like 4 post, 8 post, something in that 20 post
yeah,
for these deals. And I think that's where the compression is going to start to come from. It's going to come from the absolute crazy ones come down, and then that pushes everything else down a little bit. And, you know, no one's like crying at the end of the day here. Like people are doing perfectly fine. But yeah, the days of that, you know, 20 pre-seed round, I think are hopefully gone. And we'll see what it rationalizes at. I just haven't seen it yet. I also think because the really good founders are not yet raising, or they've been doing stuff very privately or quietly. So it takes time.